The Fed just admitted Bitcoin is the only asset that beats inflation, but 97% of investors are making this one fatal mistake with their portfolio. Here's how to fix it.
There's a lot of right answers for how much Bitcoin you should have, but I think that if anyone who looks into it generally finds that the zero is not one of the right answers. So I think get off zero. There's some research that shows basically the more someone is knowledgeable about Bitcoin, the larger share of the net worth it ends up being. So my general view is that if there's a time where it makes sense for you to increase your holdings substantially, I'm not the one that tells you that. You're the one that figures it out for yourself. I think that's kind of one of the biggest misunderstandings in finance. The baseline inflation rate, if you have a relatively fixed money supply, is negative. And that's because, there are billions of people working every year, generally to make things more productive. Unless there's a war or famine or something, we're generally more productive this year than we were last year, and especially as we were 5 or 10 years ago. Basically, the benefits of productivity growth should be giving us more, we can buy more per our unit of time, our unit of money, and that's not the case. There's a danger of buying too much that exceeds your conviction level or your volatility tolerance, because you're more willing to get shaken out of your position at a loss or during a big sell-off.
Here's the truth no one tells you. Bitcoin's worst crashes are its biggest gifts. Why? Because every 40% dip since 2011 was a generational buying opportunity. But only if you do this first.
And so I generally, I don't think it's right to kind of rush in more than you're comfortable with. I think initially, the pretty low-hanging fruit is to get off zero. That there's a lot of right answers for how much Bitcoin you should have. But I think that if anyone who looks into it generally finds that the zero is not one of the right answers. So I think get off zero. And then there's a couple steps you can make. You can experiment with it to some extent. You could buy some from an exchange or a brokerage and then pull it into your own self-custody and try sending a transaction with amounts that you're comfortable with, given the research, with like a simple mobile wallet, and you can graduate toward more secure options for larger amounts if you decide to go that route. You could also invest some time into reading a handful of Bitcoin-related books. It's not necessarily the first thing you want to do is if you want to get them into Bitcoin, you don't necessarily shove them a 400-page Bitcoin book. But if someone, for example, watches this podcast or watches your series or is otherwise interested in the asset, I think the next step is to spend a weekend, read a couple high quality sources on it, so that you get more of the details that we can cover in a conversation like this, and then consider getting off zero.
An MIT study proved something terrifying. The more you learn about Bitcoin, the poorer you feel. Why? Because normies who own 0.1 Bitcoin now outperform 90% of Wall Street. Here's how to catch up.
And generally, the more you learn, there's some research that shows basically the more someone is knowledgeable about Bitcoin, the larger share of the net worth it ends up being. So my general view is that if there's a time where it makes sense for you to increase your holdings substantially, I'm not the one that tells you that. You're the one that figures it out for yourself and decides that your level of understanding or comfort with the asset has increased, and therefore a larger position might be right for you.
I think that's great advice, because the last thing you want to do is get out over your skis, so to speak, when you don't yet understand exactly what you own and the power of this thing, and then end up seeing a big correction in the price and selling at a loss, and then feeling disenchanted and jaded and like this, you somehow got screwed over here. So yeah, I would always recommend to people too, dollar cost averaging is a great way to do it. Buying a little bit every day or every week or every month, smoothing out that volatility. And I truly think of it as my savings technology. As you said earlier, it's how I save for the future, for my family. And I'm curious too, because we're running up on time here. And one thing I wanted to ask you is just, is there one thing that you wish everyone, whether they're a Bitcoin fan, or they're just thinking about Bitcoin, or maybe that this is the first time that somehow they stumbled upon this show and they're just hearing about Bitcoin for the first time, what do you wish people understood about money today, about the system as it exists today, that maybe is not widely understood?
So I'll give two answers. One, because one of them is kind of a repeat, but I'll rephrase it. is I think the biggest thing to realize is that the baseline for price inflation is not zero.
The government lied to you about inflation. Productivity gains should make prices fall 3% yearly, but your dollar buys 40% less since 2020. Bitcoin fixes this by design.
It's negative because on average, we get more productive at things, not less productive. And therefore, the thing you always want to focus on, the question you want to ask with most financial assets is, what is my rate of dilution? If I'm holding dollars or any other currency, look up the long-term growth rate of that thing you're holding, offset by whatever interest rate you expect to get on that holding, and that's your net dilution. So if your money supply is growing up by 7% a year and you're getting a 4% interest rate, you're getting diluted by an average of 3% per year. Your share of the network, aside from new income that you're actively working for, just your passive share of the network is shrinking. And it means someone else is growing, someone else is getting that. And so that's number one. And that applies for multiple things. That applies for, if you're holding gold, your long-term dilution rate is somewhere around 1.5%. And you can look that up for yourself. If you are holding equities, sometimes they're issuing shares, sometimes they're buying back shares. You can also think of it in terms of market share, or other companies kind of taking market share from your company on average, or your kind of national stock index. And the same thing with real estate. If you own real estate, there's some degree of new growth, that like the new construction that's happening. And so your share of, all houses that exist is shrinking, which can be a funny way of looking at it. But I think if you apply that lens to everything you could own as savings, that's a really important baseline. So CPI is not your target. Not getting diluted is one of your main targets. The second thing I'll say is actually about Bitcoin rather than the existing system. If people ask me one thing I wish they'd know, and I don't see commonly mentioned, there's a natural tendency to assume in technology that new things displace old things.
Fun fact, Ethernet is 50 years old, and Bitcoin is the Ethernet of money. Why? Because boring protocols outlive every upgrade, and BTC's 16-year dominance is just getting started.
That anything newer is going to be just better in every variable than older things. So new computers generally better than an older computer, for example. Newer software is better than software from a while ago, with some exceptions. And so people naturally assume that, okay, Bitcoin is cool, but it's 16 years old. Why shouldn't I assume some of these newer ones are better? And my general answer to that is the main exception for that rule of newer technology being better is communication protocols. So things like Ethernet, that's 50 years old, we're still using Ethernet. USB, something like 30 years old, we're still using it. Simple mail transfer protocol, something like 45 years old, still going strong. Internet protocol is so far in the age of the internet, the answer for how long a communication protocol lasts once it becomes dominant is indefinitely. We don't really know how long these things last because they're going on decades and they're still just as strong as they ever were. And some of them gradually update over time. So Ethernet is faster than Ethernet from 20 years ago. USB 3.0 is faster than Ethernet 1.0. And what they have in common is that they achieve network effects, and they're by design, they're purposely simple. And things that change more rapidly are on the edges of the network or on higher layers of the network. And Bitcoin, I would generally argue, is that 16 years in, it's the dominant communication protocol for money. And it exhibits very similar dynamics or similar, aspects to those other types of communication systems. And I generally think that's the right way to conceptualize it as a technology, not as something that keeps coming and disrupting the prior thing, but something that, comes out, gets tested, wins whatever early dominance it needs to win, achieves, large market share, and then becomes a pretty persistent part of our digital lives.
Does that mean it's fair to say that for somebody who's still hesitant maybe about Bitcoin because they're feeling like I've missed the boat, I'm too late, does that mean that they're still early in this development?
I think so, especially on a risk-adjusted basis. It's not as early as 2011, but it takes much less risk than it did in 2011. And one way to think of it is that the Bitcoin network is something like 0.2% of global assets. Gold is something like 2% of global assets, so about 10 times bigger.
Gold is 2% of global wealth, but Bitcoin is already eating its lunch. Institutions are dumping ETFs to buy physical BTC, and this chart shows why $500,000 per BTC is conservative.
and all the other assets together. So savings accounts, bonds, real estate, and equities, and private businesses, that's the other 98%. And so one way to think of it is, what is the total addressable market of a portable, leading type of money with no long-term supply growth that you can self-custody yourself, or that you can send to anyone in the world in seconds or minutes, depending on what layer of the network you're using. I think that's worth at least several percentage points of global assets. Some people have higher estimates, and they're not necessarily wrong. I think 0.2 is still early. I would advise people against unit bias. We look at it as 21 million Bitcoin, but it's actually 2.1 quadrillion units. In the actual code, that's the actual unit. It's just the underlying Satoshi unit that we call it now. Satoshis is still very cheap, and I think the network is still very small compared to what it could become and what it should become, as long as some core tenets of it keep working as expected. So I try to describe it as a technological problem first and foremost, but that doesn't necessarily require really deep technical understanding. There's just some key points. And so I kind of separate the financial history into kind of three main eras. So the first era was pre-Telegraph. That's when everything was analog. And so there were monetary technologies, things like coinage, things like paper and the printing press. We don't really think of them as technologies today, but at the time they certainly were these new technologies that allowed basically forms of ownership and money to move around quicker and transactions to move around quicker. But once they invented the telegraphs, that was the 1830s, and then by the 1860s, we had cross-Atlantic cables, cross-continental cables, and you could talk almost instantly, or send low bandwidth signals almost instantly around the world. And that means you could do transactions almost instantly around the world. And the way that I describe the problem is that opened up a really big mismatch between transaction speeds, which could now just go around the speed of light almost, and settlement speeds, which at the time were still physical gold and other, physical valuables. And the main way that they bridged that gap was to have a big centralized ledger. So either big commercial banks, or in many cases a central bank that all the commercial banks build on top of. And that becomes a trusted layer that everybody has to use to bridge between settlements and transactions. And whenever there's a really big centralized honeypot, it's prone to manipulation. It's prone to people misusing it for various reasons and kind of breaking that trust. And the reason I look at that through that technological lens, because I think for the first time in a very long time, that gap is closed. Because Bitcoin, it represents multiple things, but in this context, it represents the invention of fast settlements.
Prediction: by 2027, every central bank will hold Bitcoin, not as risk assets, but as settlement layers. And the scary part? They're already quietly accumulating.
So after basically a century and a half, we finally had the settlement side catch up to the transaction side. And that, of course, took a lot more bandwidth, a lot more inventions that just had to be created over the course of that period of time. And so I would say money's been broken. It's partially because of individuals making decisions. So we can point to, the creation of this central bank, or this politician making this decision at this time. Those are all true. But I think the structural underlying problem for why it's basically broken in every single country, and it's been broken for a very long time, is because we've kind of lived through this technological mismatch. And that's made it very hard. Basically all the incentives in front of politicians and central bankers and policymakers in general erred toward making it very easy.